Okay, everyone, welcome back. Day 3, Master Trader Program, Super Performance Workshop. I'm here. David Ryan's back, and we're going to get started. Welcome, Dave.
Yes, glad to be here again.
Let's start off just by recapping a bit here and talk about what we went over in the last couple of days. So first, we went over categories and catalysts. We talked about the various ways that we categorize companies. And the reason is because we want to know what the company does, what industry they're in, and what type of company it is. Because if it's a turnaround situation, we have to apply our earnings metrics a little bit different than it's a straight growth stock. If it's a biotech stock or some stock on a drug that there is in the pipeline, they probably don't have any earnings. Good chance that they don't have any earnings. 75-80% of biotechs don't have earnings. So now we're trading it off the technicals, and we're trading off of FDA approval process. And then cyclicals have an inverse relationship, an inverse PE relationship. Big institutional stocks, I like to buy those low in the base before they're obvious off of bear markets. You get some opportunities off of bear markets to buy some of what they call stalwarts or slow growers. So you really want to know what category the company's in and what they do, and know a little bit about that company so you can figure out exactly how you're going to approach it. Then we talked about valuation, where basically, we don't really, valuation is not something that David and I really get too concerned about. When if it's a real low PE, if the PE was like 4, then we might be thinking, okay, that's very abnormal. But a super high PE is okay if the growth is there. And sometimes even with the biotech, it's trading on the prospects of a blockbuster drug. So we smashed some common some common things that are thought about valuation and some myths, if you will. The trend, we talked about the trend and how, of course, you want to be in a stage 2 uptrend, and that's really the only stage that we want to be in. We want to make sure that the stock is in that stage 2 uptrend before we even look at the stock. And you can do that if you're using MarketSmith. You can use the my trend templates that are in MarketSmith. Fundamentals, we went over the fundamentals, talked about earnings, sales, and margins, and sliced and diced them in a whole bunch of different ways for you to be able to apply them to the various types of categories. And then we went a lot on price and volume, which we're going to do more of, and entry points, and really started fine tuning and coming down to a very, very specific days that we're looking at, and volume days, and looking at confirmations and violations. So now we're going to talk about one of the, and this is sort of I don't want to say, I guess it's a 2-part. We talk about 2 of the areas or setups that we really favor for big moves in stocks. And one is what we call a magnitude play, and the other one is what we call a velocity play. Now, today, or right now during this session, we're going to talk about the magnitude play. The magnitude play is the primary base, which is usually the first buyable base after an IPO, or sometimes it's the second base. It's very, very close to the beginning life of a stock after it goes IPO, which we call the primary base. The reason why we call it a magnitude play is because this is where, if it's going to become the next Starbucks or the next Amazon, this is about as early as you can get, other than getting it on the IPO. So there's a huge move that's potentially on the table. Now, a velocity play, which we're going to talk about in the next session, is what we call a power play, and these are setups that can move very fast, and they can make a large gain in a very short period of time, and that we're going to get into later. So we're going to focus on the primary base, which is the first buyable base. Now, I don't know, Dave, is there anything that you want to just open it up here before I get into some charts? Anything you want to say about the primary base? And
well, I'd just like to add that a lot of the greatest winners were IPOs, and maybe not all of them were brand new IPOs, but a lot of them were IPOs within the last couple of years, and maybe even back 3 years, but a lot of them were IPOs. These are ones that institutions, if they see a great story and great earnings, they're going to have to get aboard, and so that's what causes some of those great moves. after an IPO has gone public.
Yeah, and during live trading, when we're screening with MarketSmith, we'll show you some screens, and I have one in particular that's specifically for IPOs. It's a really great way to look for the IPOs and to scan them. As Dave was saying, when we look back and we look at the biggest winning stocks and the fastest moving stocks, 80% of them were IPOs within the last 8 or 10 years. So they're relatively new. Even a 10-year-old company or that's been public for 10 years is really not that old. When you look at Coca-Cola, that's been around since, I don't know, the 20s or 30s. GE, these big companies, or even Amazon's been around for decades. So just 3, 4, 5 years, or even 8 or 10 years is relatively new. So let's show you some examples. So Yahoo, which another thing to point out here is that some of these stocks you're going to look at and you're going to say, oh yeah, I know Yahoo, I know these names. But at the time when this was an IPO and just coming out of this base, very few people knew who Yahoo was. This is 1997, and this is where I was buying it. I was buying it right here, and I was trying to get. This is when I had institutional clients. I used to advise some of the big hedge funds, the traders over at George Soros Management were my customers. A lot of the real big hedge fund guys were my consultant clients, and I went around pitching the Yahoo and some of these other internet stocks because I thought the internet was this next big big theme, and they were all setting up and breaking out. And at the time, we talked about this, during the valuation section. The PE in Yahoo was 908 times earnings on this day that it was coming out, and I was buying it. Nobody wanted to touch it. They did not want to go near this stock. And this stock went up almost 8,000% in just about 2 years. So again, this is really, and also you'll notice here, you see how it breaks out of the base and then just comes in for a couple of days, but then boom, you get the tennis ball action. See that right back, even though it didn't follow through, it came roaring back and the volume came up. Now, look at this is a big VCP, and you really say you get tightened right here. You come down 1, 2, 3. You can call this a 1, 2, 3, 4, but perfect VCP. This is as good as it gets, and you'll see stocks set up like this all the time. Right in the modern right to this day, you'll see stocks set up like this all the time. Take a look at Amazon. So again, now here when Amazon's breaking out, this also is in 97. Right around the same time, we're looking at July 11th of 97, and a little bit after that, we're looking at September 5th, 97. Amazon starts coming out. Perfect little base here. You see, again, correction, similar to something like a Facebook or a LinkedIn, where it went IPO and had a big correction first, and then tightened up, and now right here, this is where it's ready, starts coming out. I was buying it right here. This was another stock that nobody wanted to touch. The word on the street, or the research that was on Amazon at the time on Wall Street, the common, I guess, opinion of Amazon was that they would never make any money. I don't remember if I said this before, but the thought about the internet back in 97 was that nobody would ever make money in retail online. Nobody would make money. And the only thing that would make money was pornography. At the time, that was sort of what, was broke as the first sort of retail business online was porn. And the funny thing is now decades later, the porn is free and everybody's making money online in retail. So it was completely 100% wrong as far as what the research was saying. And again, the stocks were breaking out. The stocks had that intelligence. And this stock just in 16 months went up 2,500%, and then almost 80,000% in the next 2 decades. So again, right here, if you bought it here, it would have never come down to your purchase price again. And let's say you just, you bought this stock, and even if you swing traded it and it went up 20% and you sold 90% of it and you tucked 10% away, I got news for you. Regardless of what that number was, it'd be worth a heck of a lot of money right now. Let's take a look here, a couple more. So Starbucks, And, again, these are names that you know, right? These are household names, but they were not household names at this time. And you can see how they're all setting up with this VCP and giving you that perfect entry point. We can go back. We can look at 1920s, the 1930s, the 50s, the 70s, the 80s, the 90s. Same thing. Same thing happens over and over and over and over. So, Dave, the question that I always get is, if this happens over and over and over, and it's so, repeatable, why isn't everybody doing this and making a fortune?
Well, first they have to change their mindset, because a lot of people are convinced that you buy low and you sell high, and you don't buy new highs. So that's one thing. And then, it requires work, and it requires doing things that most people don't want to do, is spend time researching these stocks and looking for these bases and training yourself to get your eyes and your mind set on what is a successful stock. So it takes a lot of work, and I think a lot of people, they want to take the shortcut and have someone feed them ideas, but boy, there are some great opportunities out there, and they're going to keep on coming as long as as long as they don't fool around with the tax system so much that they take away the incentive to start these great companies.
Right, and a couple of things. First of all, it takes skill. All right, it takes a skill that takes years to develop, and not too many people are willing to get that skill or to develop that skill and stick with it. There's periods that go by where this doesn't work very well, and you've got to stick with it. And so it's not easy. It's not like it's this easy thing to do. It does take a lot of work, as Dave said. But here's the thing. Here's what I like to say to people. So why isn't everybody thin and in shape? I mean, we all know you just diet and you exercise, right? I mean, considering if you have a medical condition, maybe, but for the most part, for most people, if they diet and exercise, we know what to do. All right. So why isn't everybody in shape and fit? It takes discipline. It takes discipline, commitment. So just because the answer is there, just because the path is there, doesn't mean everybody's going to walk that path or be able to stay on it. So again, let's take a look here. Dick's Sporting Goods. This is another stock I was buying right here, and it's similar to some of these other names like the Amazon and also Yahoo, where you get this big cup, if you will, and then you come up the right side, and then you really start tightening, and you go through those tightings and you get a nice VCP action. Notice how every single trade that I'm showing you has VCP characteristics. Everyone. We're not going to show you, I don't think, one single stock through this entire, unless it's in the selling section. For buying, we're not going to show you one single stock that doesn't have VCP characteristics. And 99.9% of every stock that I ever buy has VCP characteristics. So it's real important that you understand whether it's an IPO, no matter what it is. So some people say, well, why don't you buy it? Why don't you buy on the IPO? If it's such a great company, maybe buy it right after the IPO. Dave, why are we not going to buy, pre-IPO or even, maybe one day or a couple of days after it trades? Why do you avoid, the IPOs right off the hop?
Well, because sometimes they're very, very hyped and they come out at really ridiculous valuations, and then they have to come down and reset. So you don't know exactly, exactly how they're being priced. The best IPOs are usually the ones that come out in a very difficult market, and there's not much hype to them, and there's not that much interest in the market because you're probably going through a bear market. Those are some of the best, but you have to be careful in some of the very, very strong markets and that have been going on for a while, because the investment bankers are looking for anything they can get their hands on to go public. So I like to see them. I like to see them seasoned. I like to see them out there and trading for at least 4 weeks, a couple of months, so they can set up proper bases to go from.